Hopefully you can hear me loud and clear. I think it's important that everyone can see the screen in front of them and hear me. And I've just had a quick question from Stephen actually as well regarding our previous webinar at ADX. Stephen, you can access that certainly. We've got a recording of that. If you wouldn't mind, we're going to leave our emails at the end of the session, and you can drop us an email and I'll send you the link to the recording. And likewise with anyone else, if you'd like a recording of this, you can just at the end of the session we'll basically send out a recording for today's session, and you can then watch it and at your own leisure sometime. But thank you very much for everyone attending this afternoon. My name's Gurpal Singh, and I'll be hosting this session with my colleague Zain. Basically, we like to do these sort of twice a month, these sort of webinars where we talk about certain sort of trading aspects, and let's get starting on with things really. Just bear me 1 second. Right, we'll just sort of kick off really by just saying what today's session is all about. I'll be covering Bollinger Bands today. A trading sort of indicator which we get quite a few questions about. A lot of people seem to think they know how to use them or would like to use them, but I hope I'll go over with some of the aspects of what Bollinger Bands are and ways that you can certainly use these. Certainly, my colleague Zain will be going over our showcasing our platform. So if you've got any questions regarding that, we can go move on to that as well. Before we move on to the main sort of subject, just a bit about ourselves, 2A Markets. We're an independent sort of broker. We're not really sort of biased to any one particular broker. We tend to sort of look out for the best value for our clients in terms of spreads and obviously functionality of platform. We obviously look for ease of use in platforms that we like to sort of offer our clients. We hope certainly that we come across as a professional and friendly customer service, and obviously what today's event's about, we like to sort of at least give you a bit more education about certain aspects of trading, technical indicators, so forth. What we'll do is, obviously there may be questions as we go along. I think it might be a good idea if it's okay with everyone, to maybe leave questions towards the end of the session. But if there is something, certainly, feel free to ask the question. I mean, I'll leave our details towards the end of the session, so you can actually go on that as well. But let's get on towards today's subject, which is Bollinger Bands. Not as easy as most people like to think. Let's just say that. They're obviously, aesthetically, they look very appealing. They look, it's fairly easy. If it hits the top of the band, we just sell. If it hits the bottom of the band, we just buy. If only life was that simple. But this is the sort of the definition of what a Bollinger Band is. So if we just go through this, a Bollinger Band, basically adaptive trading bands that reflect changes in volatility and provide a clearer picture of the true extent of price movement. So essentially they follow volatility in the market price. Rather than giving you clear signals, all they're giving you is the aspect of volatility within market. As this is a fairly basic picture, but as the bands sort of tighten up, you're in a ranging market. As they retract and detract, market price the ranges are started to expand and retract. The bands will basically follow those, but we'll get onto all that a bit later on into the subject. So okay, so Bollinger Bands. Right, they were actually invented by John Bollinger. Well, not too long ago, actually. I think it was just towards the late 70s. But Bollinger Bands are one of the most popular technical indicators for traders in the financial markets. You can use them with stocks, bonds, foreign exchange, indexes, whatever you like. Many traders use Bollinger Bands to determine overbought and oversold levels. So as I mentioned, selling when the price touches the upper band, and buying when it hits the lower band. In range-bound markets, the technique can also use you can use it very well as well. But if you think about the top, the analogy, the top and the bottom band as two walls, and the price action as a ball which is bouncing between these two walls, that's, I think, is a good way of sort of looking at it. The price, more often than not, will stay within the band. So if you look at the settings below, this is the default setting for most Bollinger Bands on any sort of platform, standard trading platform that you use. So the middle band is a simple moving average that is usually set up as a 20-period moving average. It's a simple moving average because the standard deviation formula which goes with the SMA is also a simple moving average. A look back period for the standard deviation is the same as a simple moving average. So the outer two bands here, so the middle band here is just a standard simple moving average. The outer bands are a simple moving average but with a standard deviation. The upper band, I'm going to move on to standard deviation in a bit, so please bear with me. I know some of the terminology might get a bit mathematical and so forth, but I think it's important to, to basically explain what Bollinger Bands are and how they actually, sort of appear and why they appear. But just to let you know, the upper band is +2 deviation, standard deviation, and the bottom band is -2 deviation. As mentioned down here, 90% of the price action should remain within the two bands. Right, this is the standard deviation. I'm not going to go too much into this, being it's an afternoon and most of you are probably hungry anyway, but this is the mathematical aspect of what Bollinger Bands are. A standard deviation is a measure of statistical dispersion. Plainly speaking, it's how spread out our closing prices around a specific average, moving average of those. So we're using a 20 moving average. So if we look at this diagram here, say for example this zero line is a 20 moving average. All we're looking to do here is how many of those closing moving averages are within that 20 moving average, how close are they? And the standard deviation here is, as I mentioned, +1. So if this is a 20 moving average and we have a standard deviation of +1, we would only get 68% of the closing prices within that bracket. A +2 standard deviation, what the default setting is, would include 95% of those closing prices within the 20% moving average. Hence the reason this is the one that most of us use, the 20 moving average and the +2 and the -2 standard deviation. 99% is +3 plus negative minus. You might ask, why don't we use that? A lot of that, it starts getting a bit too much, not inaccurate, but 95% is probably what John Bollinger sort of suggested would be more than enough. One thing I would like to go forward with, just before I move on to the next stage, again, the larger standard deviation, the greater the containment of prices. So basically, obviously, if this standard deviation was more, if it wasn't 20 moving average, if you're using 10 moving average or 50, you would then slightly adjust your standard deviation here. I'll move on to that in a second here. So settings, as I said, can be adjusted to suit individual characteristics of your type of trading. So you may be a scalper, very short-term trading, or you may be sort of medium-term or long-term type swing trading. So, for example, if the standard setup here is the 20 moving average, with the standard moving average, we use a 2 standard deviation, so +2 with the upper band and -2 with the lower band. If you're a scalper, if you like sort of a high frequency trading, you're in and out of the market very quickly, you might like to use the 10 moving average. If you like to use a 10 moving average, you only need to make a very slight adjustment to the standard deviation. So what that will mean is you'd have a 10 standard moving average, you'd have a plus 1.9 deviation and a minus 1.9 with the lower band. So only very fractional different changes. And if you're more of a swing trader, someone who likes to look at the daily 4-hour charts, you may like to use the 50 moving average. Again, with the 50 moving average, you would go the other way. So the upper band, obviously you'd have the 50 SMA, the upper band will be 2.1 plus standard deviation, and the lower band will be minus 2.1 standard deviation. I'll come back to this when we're sort of summarizing things up, but obviously it is very much a mathematical based system, and it's important to get your settings right if you're going to use it. So if you're a scalper, it's no use using a 20 moving average, or if you're a long-term trader, vice versa, it's not worth using a 50. So just get your settings right before you sort of start using it. So we'll sort of crack on with this, because I know I don't want to spend too much time on with the setup of all this, but walking with the band. So basically, as with most sort of technical indicators, this is very much sort of a lagging type of indicator. So moves are often below bands. So even when moves are hitting bands, top or bottom, they're not signals as per se. As the guy who actually made this, John Bollinger, he likes to say that they were actually seen as tags rather than that. So on the face of it, if a move to the upper band shows strength, while a sharp move to the lower band might show weakness, momentum oscillators like this only sort of look at price action being overbought rather than bullish. So it takes strength to reach overbought levels, and overbought conditions can extend to a strong uptrend. Similarly, if you're seeing the band expand with the Bollinger Band, it doesn't necessarily mean we're about to reverse. All it could mean is we're just entering a phase of bullishness. A lot of people automatically start selling as soon as we start hitting the bands, and like with a lot of these indicators, be it MACD, RSI, a lot of these indicators can overstretch, and I think this is a mistake what a lot of people make. But a majority, as mentioned, very few closing prices should be above the top of the moving the Bollinger Band, and very few closing prices should be below the moving average, the lower band, should I say. You'll see a lot of price action is very much interacting with the central SMA. You'll find once it touches the top moving average, it'll always come back down to the 20 or whatever the center moving average is before it carries on, continues. So the center moving average does play an important part of this. So we'll move on. So I'm going to sort of try to simplify things if I can. But if you look at this simple chart, or simple diagram, should I say here, if you examine this, the Bollinger Bands, which are blue, the price action is actually going with the bands themselves. So we only trade candlestick patterns when they are placed on the upper band or the lower Bollinger Bands. So these bands mark an extreme point in prices. So prices at these extremes are more likely to return back to the center or the middle Bollinger Band, which is obviously the simple moving average. So by choosing a shorting candlestick pattern, the upper Bollinger Band, we can combine two powerful signals here, that the price is at an extreme area, and then potentially we could look to short an area if it pierces the top band. When prices are at extreme levels in Bollinger Bands, the price action is much more likely to go one way, that is into the center. We know that when a candlestick pattern appears, it indicates that price action is about to go in one particular direction. So by observing appropriate candlestick patterns on Bollinger Bands, we can greatly amplify probability of price action. So although price action can appear to be following the Bollinger Bands, a lot of the times you'll find it always go back to the center and continue. So you can use them as continuation patterns. Like with most indicators, by itself, it's going to be weak. You've got to really use it coincided with a lot of other indicators. So if we move on to the second diagram here, there are two candlestick patterns on this drawing, and the red one is a shorting pattern and the green one is for going long. The green and the red lines show the relevant price action, so whether the price is going up or price going down. So note how the patterns break the trend of the price action only slightly. So a few candles later here, the price action resumes its original direction. This diagram then shows the incorrect use of a Bollinger Band. So if you start selling here, if you start buying here, you know that although the price action is the candles are red, the crossover here of the candlesticks will always, once we've broken through, will always appear in sequence. We'll all start following the bands going up. So as I mentioned, this is not price confirmation, this is mere volatility in the market. So therefore, you can see the second pattern on the Bollinger Band. You can expect a successful trade after this pattern has been completed, but under no circumstances can you expect a successful trade on the expanding band with the appearance of only one pattern. So, once you get a red and a green candle, only then you can potentially take that trade on. Here, a very simple use of two bands here. This is when you look at when the bands are going away. So if, for example, one band is heading north, one band is heading south, you can actually use the charts, the candles, to be actually literally confident. They'll be basically following the band going up. So any pullback would be a buying opportunity with the green soldiers. Any red likewise would be selling opportunities with the band going south. This is a lot more definitive when the bands are sort of widening like this. When the bands are widening like this, you can safely say that volatility is increasing. With the volatility increasing, you can then sort of basically go with the trend, and as long as the price action is not pierced the Bollinger Band, you can actually use simple scalping strategies to move forward, whether you're going up or down. Again here, this is when the bands are contracting, so they're going the other way. So when the bands are contracting, the price action is being returned back to the center. So once the price action is returned to the center, that is the mid Bollinger Band. At this point, a shorting pattern is used on the upper Bollinger Band and the lower Bollinger Band respectively. This ensures that you're trading with the trend. So obviously once these start retracting, you know that it's worthwhile waiting for the Bollinger Bands to start splitting open again before you start going up and again. So if price action, as this Bollinger Band starts to react, price will start peeking its head above these Bollinger Bands. Areas of shorting would appear up here once price action is above that top Bollinger Band, and areas of shorting or buying opportunities, should I say, would appear here once price action is below the blue Bollinger Band here. So it's worthwhile having a look at how price action is affecting in and around Bollinger Bands here. So let me just summarize what I've just said here. I know it can seem a bit complex in terms of what Bollinger Bands are, but this is the only real simplified way of trying to explain what they are. So for Bollinger Bands, use patterns that direct the price away from the center. Yeah, for contracting Bollinger Bands, so Bollinger Bands which are coming together, use patterns that direct the price towards the center. So for level Bollinger Bands which are like a sort of a channel, very tight, check which way the bands are likely to go, but generally use the patterns that direct the price towards the center. So whichever way the price action is moving, always use that band as per se. So do not use patterns where there is little width to the Bollinger Bands, as there are no sign of them expanding. So where you see a very tight sort of contracting of Bollinger Bands, they're the ones to stay away of, because obviously you're waiting for that price action to break out up or down. What you don't want to be doing is guessing which way a price would be using, which way the price may be breaking. Here is some very simple charts. If I look at this, here is what is it? We've got a sterling dollar. It doesn't matter what chart we're using, but here's the top Bollinger Band here and the bottom. If you look at the yellow band, we're just touching the area, and once we've pierced the top of the range of the Bollinger Band, once we close below that area, the next coinciding candle potentially would be that selling signal, would be a sell. I'm going to come out to more strategies a bit later on, but again here we've hit the top. All we've done is we've gone back to the center pivot here, the center 20 moving average, and we've gone back above. So the central Bollinger Band, the central moving average is key here, because once we've tagged the top, more often than not, once we've given out a sell signal, we'll always return to the center. Again, we've gone back up. Here we've broken then, and we've actually pierced the bottom. Again, if we've taken a buy signal here, all we've done merely is gone to the center before we've sort of consolidated and continued our way up. It's the same with all these Bollinger Bands. These are extreme price actions where we're seeing where the price action is below the bottom Bollinger Band. Potentially there's a buying signal here. You'd need to use this alongside with support and resistance and MACD just to see how oversold certain areas are. If you're seeing most oversold periods here on your RSIs and so forth, you know that potentially there'll be a quick buying opportunities. A lot of scalpers like to use Bollinger Bands. I think more scalpers more than anything that potentially do like to use Bollinger Bands. If I move on to simple scalping strategies here, I mean, if you look at this here, this is the bottom band, the top band, obviously the middle standard moving average. This is a standard 20 moving average. Once the downward price action has sort of pierced the bottom band, we can look to make an entry once we get a reversal candle. So once we've got our reversal candle here, we're not going to be basically buying on these sort of areas here, because potentially this band can it can hug this line, it can carry on going down, it can expand. All this is showing us is volatility. If we can have an entry here, more often than not, the price will then fluctuate back to the central moving average. We can take a buying opportunity. Fair enough, it's only 13 points, but you know, people might say, I'd like that. Some people may like to take it all the way to the top, but more often than not, with a lot of scalp type of trades, you would certainly take it at the center. Right. Yeah, Kieran just asked me a quick question here. What time frame would we use the 20? Kieran, I'd probably say 15 minutes to half an hour. You can use the hourly moving average, the hourly time frame to that, really. What you don't want to be using is you don't want to be sort of messing around with 20 moving average when you're scalping the market. You're probably using the 10 moving average there if you're scalping the market. 20 moving average is more so your day type trading. So if we just move over to the next one, again here, look at this extreme price pattern. We've smashed down and we've pierced the bottom the bottom band here. We've then had a reversal candle. That potentially is your buying opportunity. Once you've bought that, you've probably put a stop loss just below where that previous candle has hit. Again, we've tried to move back down, but we've failed. All we've done is we've confirmed a reversal here. So we've bought the market here, and we've then exited back to our 20 moving average. You know, it looks quite simple here, but you know, what's key here is looking at our confirmation candle. It's no good me selling here, for example, because I've not got any confirmation of that sell candle here. Say, for example, I've sold here. our next candle will be stretching this all the way back up there, and all what the Bollinger Band will do is carry on going. So potentially we could be stopped out here. What I'm waiting for here is the confirmation of reversal. Once I've got that second confirmation of a reversal candle, I can go and sell here. We've tried to go back up, but guess what? We've carried on going down. Again, it's quite a powerful tool to use if used powerfully. So that's that strategy. It's only 11 pips, but again, this is a scalping type strategy. Move over to the next one, confirmation of, this is more of a sort of a channel type trade. We've not got any, we've sort of broken out, it could be a news announcement, but again, we've broken out of this bottom channel. Once we've broken out of this bottom channel, we've got opportunities there if you think about it. But I've pointed out this one more so. Reason being is we've got a very strong reversal candle here, and the candles is what's important here, because it's giving you, it's sort of like a game of poker, it's giving you that inclination where the market has done its worst. We've done our downward move, but we're looking to go back up. So potentially we could start buying once we've crept back into that bottom candle. So once we're buying within there, we've got all that. A lot of people, what they generally do, what a professional trader would do is once they've entered into a buy situation there, they would take out half the trade. Say for example, I'm doing, I don't know, a euro-dollar position, I'm doing £10 a point. What I would personally do here is I would close half of the position. I would close £5 of that position, and what I would generally do then is I would move my stop loss to break even. And once I've moved my stop loss to break even, all I've done is I've banked £5 of my profits and I've left the rest to continue. And what I would generally do is close my position off there. It's a safe way of trading. It's a very good strategy. I've worked in proprietary desks before whereby I know traders use this strategy. Closing half your profits is a very good way of sustaining your profits. And you know what, I've seen so many people that thinking, I don't want to close half my profits, I want to wait for their, potentially this could reverse. All you've done is lost all that profit that you would have potentially banked. With this sort of level of protection, all you're doing is, if it does reverse and it doesn't hit the top of your envelope here, top of your Bollinger Band, all you've done is you've banked half the profit and you've been closed out at break even. So, it's a very powerful tool. Let me just move it. Yep, got one more here. Again, an interesting one. So we've had an extreme price move. So we've had a period of consolidation here, but then we've had the market boom up here. And again, so many people I see try to be heroes and try to sell the market at these sort of levels here. Just because we're pierced outside doesn't necessarily mean we'd want to sell. If we would have sold, we would have been stopped out here. Say for example we've sold here, the market then came back above and stopped us out. So we want a confirmation within that band. So it's no good me selling at these levels. If I'm selling at these levels here, I've got a potential of having this spike me back out again. So once the market has closed within the band, you've got a safe trade there. Yeah, ideally we want to sort of wait for that completion of that candle, and then once that candle's completed, Rob, we can then take that trade on. And as you know, that all that trade has done is we've come back down to the central moving average here again. We've tried to go back up. All it's done is carried on going back down to the safe. Potentially you could take 15-point profit there. So that's the way we look at that crossover really. We want to wait for that confirmation that the candles sort of moved over. I've got 15 sort of basic rules. I didn't want to bore you too much with sort of general rules, but these are just sort of simple rules I think are sort of fairly important to look at. So Bollinger Bands provide a relative definition of high and low. They're not going to tell you, we've hit a high or hit a low. All they're going to tell you is relative to what the price action is. That relative definition can be used to compare price action and indicator action to arrive at a rigorous buy and sell decision, as explained. So it's going to just explain to you, once that price action has been exhausted, it may well tell you where that help you with that buy and sell decision. going forward. Volatility and trend have already been deployed in the construction of Bollinger Bands, so we've used that in the standard deviation. So for their confirmation of price action is not really recommended. Indicators used for confirmation should be directly related to one another. Two indicators from the same category do not increase confirmation. Bollinger Bands can be used to clarify pure price patterns. So such as, I don't know, most of you guys like to use sort of wave analysis, M-type, W-type bottoms. This is where Bollinger Bands do come into their own. You can really sort of scalp the market or short daytime trade these type of moving. As long as you get that reversal candle within the Bollinger Band, you know, it's something you can sort of take 10, 5 points out of the market. I know a lot of high frequency traders we've got use this type of, I mean, they may do 20, 30 pound a point on their trading, but all these guys are using are 5 or 6 points. So once that reversal candle has been confirmed within that Bollinger Band, they'll take that trade on. Once they're in, you know, they'll take that trade, they'll make 5 or 6 points and they're out. Price can and does walk up the Bollinger Band and down along. So many people make the mistake of selling too early or buying too early if it starts hugging the top and the bottom. Always wait for that confirmation. Like with any sort of lagging indicator, these can stretch over time. So be aware of that. So closes outside the Bollinger Band can be continuation patterns. Remember that. So if a price action is going up, you can actually, if the price does go within the Bollinger Band again, you can actually use that to buy as a continuation trade. So they're not reversal signals, as is demonstrated by what I've just mentioned. So default parameters are 20 moving averages for moving average and standard deviation. The two standard deviations for the bandwidth are that they're just defaults. They don't necessarily mean you have to stick to that. It depends on what type of trader you are. It sort of moves on to point 10 here. So if the average is lengthened, the number of standard deviations need to be increased simultaneously. Obviously, if you've got 2 moving average, 20 moving average, the standard deviation would be 2 and -2. If you're sort of more of a long-term trader, the standard deviation would be plus 2.1 or minus 2.1. And if you're a scalper, you might like to use the 10 moving average. Your standard deviation would be adjusted to plus 1.9 and minus 1.9. It's very important that you get these settings right if you want to use this properly. So, you know, obviously decide at what type of trading you're going to do, scalping, mid-term or long-term, and the settings very much sort of based on standard deviation mathematical formula. Once you've got that right, the rest of it should sort of fall into place. Bollinger Bands are based on simple moving average, as we've discussed. And finally, the bands are tags; they're not signals. This is what John Bollinger said. That's all they're giving you is that they're not. It's not itself a sell signal or a buy signal. All it's telling you is the volatility has reached a peak where we've come out of the top of that Bollinger Band or bottom of that Bollinger Band. Unless we get that reversal candle, we wouldn't really want to entertain that trade. So it's important that you make yourself aware of that. I think that's about it, really. I was just trying to think if there's anything else. What I'd probably like to quickly show you, I know we're sort of getting on with time here, is we're going to go with the platform, but we're going to use the ETX platform here. I just want to quickly show you a couple of charts using Bollinger Bands. So if I've got the FTSE chart here, I'm going to let Zane sort of show you this as well. So I'm sort of stealing his thunder in a way a bit, but just bear with me 1 second. So here's the FTSE chart. Let that load up. And I'll say, for example, I'm using the 30-minute chart here, and I can add the Bollinger Band here. So it's Bollinger there. And you know when I was talking about moving averages, this is where you can move your moving average. Say, for example, I'm doing a 10 moving average. I can then change the standard deviation to 1.9, as I mentioned before. So let's just leave that at 20 for the time being. simple moving average, and I've closed that. You can actually change the colors and the width of these, so it's quite nifty here. But again, if you look at this, just a simple FTSE chart. Like I said, I'm not going to spend too much time here. This is just a simple 30-minute chart here. We've pierced the bottom moving average here on just a couple of, well, yesterday. Look at that extreme price movement. I wouldn't really want to be buying here. I wouldn't want to be buying anywhere down there. We've started to reverse here. The only point I would like to be buying the FTSE is once we've come inside that bottom average. We've had a reversal candle here. So for those of you who are very aggressive traders, you might want to take a buy here. Again, those of you who are more sort of conservative, you might want to look to take the buy here. And if you would have done, let's have a look at that, 67.41, I would have probably closed there, 67.61. That's about 20 points. It's not bad. So, it does work. Those of you guys like to lose it. Again, let me just use this one last example here. We had a breakout here a few days ago, on the 13th. The FTSE had an extreme breakdown, and on multiple time frame, multiple price action, the FTSE candle finished below. I wouldn't want to buy at any of these candles because all we're doing is selling, lots of selling pressure. Only here, where we've had that close above, we've had a reversal candle here, I would then potentially, on a reversal of that candle here, I would like to buy. So for example, if I bought here, which is at 67.60, if I bought there, we would have gone all the way back up here. I would have probably closed there, 67.87. Again, not bad. We're talking just over 20 points there. In hindsight, it looks good, but if you stick to those rules, it certainly can work for you. Kieran, how does it look on a 15-minute? Yeah, let me just change it on a 15-minute time frame. We'll just give you quicker trades, Kieran. So what I'd probably do is change my studies here. I'd probably change it if I go to my... I'd probably change that to a 10. Well, all that's done is actually overlapped. Sorry, I've made a complete hash of that, haven't I? Let me just get rid of that one. Well, let's get rid of that chart. I think I've just let's just use gold. So all I've done here is, here's the gold chart. Here's a scalping type of trade. Well, you probably use this 15-minute for the scalp here. I've gone for the studies and Bollinger. I've changed the moving average to 10, and I've changed my my deviation to 1.9. So 1.9, and I'll close that. Again, all I've done is I've used the correct settings. So here it is. Here's the 15-minute. All this means is it's going to be less pips. So those of you who are high frequency, very scope, look at this one here. We've basically gone crazy here. We've moved all the way down here. You can't buy anywhere here. The only place you can buy is once we've sort of gone back above within that channel, within the Bollinger Band. And say, for example, I've bought around these levels here on the reversal. There, I'd probably buy. That's at 12.62. I'd probably close my gold trade once we've got that 12.64. So we're looking for around about what, $2-3 on the gold. You can obviously, those of you who want to carry on trading, like I said, close half your position, let it run, close it once we get up to 69. So those of you who want to scalp the market, you can use it for a scalping purpose as well. But there we go. There's a 15-minute chart. It will give you less pips, but it will probably give you more opportunities. Okay, hopefully that sort of shed a bit more light on Bollinger Bands, but what I'm going to do is I'm going to pass you over to my colleague. We've probably gone over more so, but I think it's worth it. No problem, Kieran. Give me a call anytime if you need a bit more explanation on those. More than happy to have a one-to-one with any of you guys. I'm going to pass you over to Zane, who will basically go over the platform with you now. So thank you very much from me. I'll probably, well, what we'll do, any questions will come back towards the end of the session, but I'll pass you over to Zane now. Here's Zane.
Hello, good afternoon. This is Zane speaking. Work alongside Gopal here at 2A Markets. Just a quick sound check on this. If you can hear me, just type a yes in that chat box over there and we can get away with the platform overview. Brilliant, excellent. Cheers, Farhad. Cheers, Kira. Cheers, guys. All right, brilliant, excellent. Okay, guys, so what we're going to go through initially is it's just this platform that we really advise for you guys to trade on and using these studies that we go through all the time. Now, this platform really is something of a great tool for you to use, especially if you want to try and put these studies on and these indicators on to help you with your trading. Just quickly going back to the chart that Gopal said, let's just take that gold there. Let's maximize that as well. Now what we get here is our gold chart, and as Gopal showed you, just to add those Bollinger Bands on, regardless of the time frame you have, all you do is click in that Bollinger Band thing there, and it will appear there, okay? Again, the periods and standard deviations vary depending on what markets you're looking at and what period you're looking at too. The stars can be changed, the line width can be changed as well. Now, one thing to do is that if we want to really keep moving within these markets and keeping fast along these sort of trends within the markets as well, we need to really make sure that we save these studies onto our graphs. It's very important. So what I'm going to do, I'm just going to close this off and I'm going to make sure that my Bollinger Bands are there the next time I want to start trading on gold. Okay? So all I want to do is I want to click on settings here. I want to save chart settings, and there you go. It's done. The next time that we go back onto that gold chart, I guarantee you that we're going to find our Bollinger Bands to be right there again. Okay, so literally as soon as you get back onto that product, those indicators are going to be there for you, so you're not missing out on any movements in the market. You're in there, you're looking for your capital, you're looking for that profit, and away you go. Okay, so yeah, I mean, this platform really is ideal for moving fast within these fast volatile markets. I mean, we want these sort of platforms to move as fast as the England team do tomorrow night against Uruguay. Okay, so yep, sure, cool, dude. Yep, what you do essentially is you just click on the settings button here. You click on Save Chart Settings, and that's it. Away you go. And there you go. That's your chart saved and ready to go for you the next time you start trading on gold. Okay. So what's great about using these charts as well is that you can actually trade on the charts directly themselves, right? So once you have those Bollinger Bands in place, once you have those indicators in place, all you need to do is once you see that trend in line, you can sell and you can buy and choose your quantity at the same time. It's a very, very convenient way to start trading because you really need to be within those markets and making sure you don't miss out on anything there, okay? And also, guys, it's not just the charts that really help you out. This platform is very customizable. It's very, very customizable in terms of you can move your order books. You can add in different options to trade as well. Let's just say we want to trade in gold and silver. We can add these one-click trading transactions onto our platform, which really does help us in terms of moving within the markets. And there you go. I can sell on the silver, I can sell the gold, and I'm done. There you go. That's all we need to do. Yes, of course you can. You can do more than one studies on the charts, Kira. If we have a look there. I mean, along these studies here, it's not just the Bollinger ones that we can really go for. There are multiple amounts of sort of studies there, and if you're looking for different types of Bollinger Bands, yes, you can do new ones as well. See that? I can add different ones there. All different Bollinger Bands there, and with each of these as well, we can make sure to change the periods. Okay. And what's great about it, change the standard definitions there, we can do everything there too as well. So this makes sure that the styles are going to be different. Okay, so you want to choose different colors. You want to make sure that the line width might be different for each Bollinger Band you want to do, but you can have a variation there as well. Okay. All right. So as long as you remember to save that too, just make sure that you have the different line widths, you have the different colors, to make sure you're not confusing yourself with the variety of different Bollinger Bands you're doing. Okay, so yeah, just looking back onto the trades, all you need to do is just click on trade button on each of the products you want to associate yourself with, and as I mentioned below, you know, all you need to do is click on them, one-click trading, very quick, very convenient, and there you go, you have sort of 4 products there within your order book already. Okay. Now, essentially what you can do as well, you can amend these orders. Obviously, you guys will be looking to put in stops and your limits. And what's very important is that you know how to do this. Okay, all you need to do on any single product you trade on, you click on the sort of the plus button there, click on order, and essentially what it does is brings up a bigger box in terms of what you're looking to do. And essentially, you can put in your stops, you can put in your limits, like that, and make sure that in the right direction. Okay, so because we're buying, that stop is going to be a negative, guys. Okay, all right, because our stop is going to be how many points we're willing to lose, so that's going to be a negative sort of a pattern there, and our limit is just going to be the opposite there. It's going to be a plus 40. All right, and all you do is click on amend. You can also set an alert on this as well if you really want to, just to make sure you're in line with the markets. Click on amend, and that's it. Your stop and losses are added to that trade, and away you go. Okay. If you want to close the order, one-click trading again, just close it, and that's it. You're out of the market. Okay. Again, you know, if we look in the studies too, now Bollinger Band on the gold's already there, but you know, if we want to draw sort of a Fibonacci retracement there, if you can see here, we did this I think a couple of weeks ago. All you need to do is just click on the button there, you know, and there, that will do your Fibonacci retracement on gold. You can do the same thing on the forex markets as well, exactly the same thing. But regardless of what you're trading on, it doesn't matter. These Fibonacci retracements can be used in any sort of product you use, and any chart you use on this platform as well. Okay. So what we want to do as well, for new clients and clients who are looking to trade with us and to gauge as much education about, you know, sort of the indicators we use to use the markets, we want to give them an incentive. We want to give them an offer to make sure that they're treating nicely here. They're treated at a company that respects its clients. And that's why we're saying to you guys that if you are looking to open a new account, going live, trading live can be daunting. It can be a bit scary sometimes. We all know that because it's our money we're playing around with, and we want to make it capital. That's why we as a company are prepared to offer you £100 cash back on any trading losses you incur within the first month of your trading. This does really give you an incentive to start trading live. It gives you that experience of trading live. It gives you the momentum to build that confidence as well. And also it allows you to have a sort of a safety net, a bit of a protection that if you do lose anything on any method you are trying, then you can always claim up to £100 back on that. We have sort of the previous webinars available for you guys as well. We did a Fibonacci retracement and an ADX webinar too. Don't worry, Kuldeep, we'll send those links across. Just put your email address down in that chat box there, we can get back to you. And that is generally, guys, the platform for you there. The spreads are very good on this as well. You know, you've got a 0.7 to the euro dollar, 0.9 to the dollar yen. All your major European indices are 1 points as well, and you can trade as low as 50 pence on that too. It even goes down to 10 pence of gold and 25 pence on the euro dollar. So it really is a very good platform that you're not really giving a lot to the broker. You're keeping those funds to yourself so you can trade with. Okay. So there you go, guys. There are our details there. Our number there is displayed there, so our emails and our Skype addresses if you want to chat with us there. Our website is down there too. And yeah, thank you for attending, guys. I hope you enjoyed this webinar today. If you do want to have any more information about some of the webinars, you know, please leave your email addresses there. And if you're interested in this cashback offer we are presenting to yourself, please type in cashback on that chat box, and we can get back to you as soon as possible. Good afternoon. Hope you had have a good lunch, and thank you very much.